I welcome you to the channel. Thanks for watching. This is Everything Money with Seth, Paul, and Mo. We teach value investing and trading. And today, Paul, I come to you. You've always said that you're going to come to Uncle Paul when times are rough. And we're talking about Discovery stock. My 11-year-old told me yesterday, Dad, we're losing it on Discovery. I said, what the heck are you talking about? This is the best company ever. I had like a 200% return on this puppy. Sure enough, I find out that since I follow the little book that beats the market. So you sort of set it, forget it, you rest easy at night. Come to find out, this thing was way up over $80. Now it went down to 20. I'm losing my mind, Paul, and I'm here for you to coddle me and tell me I'll be okay. Mo's going to tell me the news of what's going on, maybe what's exciting in the world of Discovery and AT&T. But in the end, I had a huge gain that I'm losing out on, and now I'm turning to you, Paul, to get me through this.
So first off, if you follow the little book that beats the market, and you have Discovery, you are not to touch it. That is the point of this whole entire idea that Joel Greenblatt talks about. If you start messing with the formula, you lose the benefits of the formula. Take your mind out of it. Don't touch it. Say swear.
I swear on a book of all the books.
On all your magic cards.
All my magic cards. I'm not touching Discovery.
Do not touch it. I don't care if it comes out that it's fraud. You do not touch the stock.
Why are you not going to touch it?
Because I need to follow a proven process and have the discipline to not freak out.
And the reason is you have, say, 30 stocks. Some are going to be way up here. Yeah. Some are going to be way down here, even if they were way up here. And it's just kind of balance out in the middle. But hopefully, and proven over back testing, you are going to beat the market in that portfolio over a long period of time.
That's true.
And that's what matters.
Got me feeling better already. But for our other people out there who haven't learned this over the course of the last few years, tell them what they need to know.
So AT&T and Discovery have decided to do a new, AT&T is spinning off its WarnerMedia. Now, for those who've done some research on it, AT&T spent a lot of money buying a few assets a few years ago, and now they're selling it for a big loss. They're merging it, they're spinning it off. Now, there are some benefits to AT&T on this one. One, it's going to take a lot of debt off their books, but it's also going to take away a lot of cash flow from their books as well. This new entity is going to have $52 billion in revenue. Now, for those of you eight-pillar thrillers, I want you to remember, one of the attributes for the 8 pillars is revenue growth. Next year, this number is going to plummet. This is AT&T's revenue over the last 5 years. This number is going to plummet because it's taking a huge chunk of revenue off their books and putting it in a different company. Now, the benefits to AT&T on this one is they're going to be unloading a lot of debt. AT&T did have a lot of debt. And I was urging in past videos that AT&T should take their amazing free cash flow, pay down debt, buy back shares. Don't focus as much on the dividend. I understand why they're focusing on dividend, but they also decided to cut their dividend 30%. Remember, dividends are a tax inefficient way to pay back investors. When a company makes money, they pay a corporate tax. When they pay out the dividend, they then take that profit they already paid tax on, and now you are responsible for more tax on that. So when I hear people talk about, oh, the dividend tax, it's beneficial, it's so low. No, it's already been taxed once before at the corporate level. So now Bo, did you say they're decreasing their dividend by 30%? Is that what you said?
That's what I read yesterday after market hours.
But with this debt, I read also yesterday that this debt reduction is going to save AT&T $2 to $3 billion a year in interest charges.
Yeah.
That's a big number, guys. Now, what's the benefit of that? They can take that extra savings and pay down their debt, buy back their shares, and make the company a better financial company. This is not a company that's going to be growing a ton. It's AT and freaking T. Mm-hmm. They're not huge. They're huge, and growth is going to be a lot harder for them, right?
Yep.
So they're taking off they're hoping to spin off this company, I assume for reasons of, somebody did write in the article, I give them credit for acknowledging their mistake, which is very rare for corporate people to do.
Especially that big of a company.
This is the thing, guys. With big corporations, they always try to force these mergers and acquisitions to make it look like they're busy. I don't like that. Take your cash. If you're not a sexy company, you're probably selling for a low valuation. Buy back your shares, pay down your debt, make the company a better financially strong company.
Mo, let's get into some of the numbers involving both of these companies and moving forward.
So this is, I'm happy with what AT&T is doing. So they bought Time Warner back in the day, 3 years ago, for $85 billion. Didn't work out for them. I'm glad they admitted the mistake, like Paul said. So right now, AT&T, with this deal, is set to receive $43 billion in a combination of cash, debt securities, and WarnerMedia's retention of certain debt, according to the press release and the announcement of the deal. So they are definitely moving forward. I think they're moving in the right direction with this. the big thing that I'm looking at is the shares outstanding. I hope that they start buying back some of their shares. I like that they've cut the dividend.
Yeah.
They're moving in the right direction with this. They realize that this was a big mistake.
Think about cutting the dividend is, to the average person, that's going to be a bad thing.
It's a negative. And I think that's reflected in their stock price today dropping at
one point it was like 7.5%.
Yeah. And that's a big move for an AT&T.
Big time. Now, does that mean it's a bad thing? No. I haven't looked enough to see what their plans are in the future. What's going to happen is shareholders for AT&T will own 71% of the new company, and shareholders of Discovery will own 29% of the new company. This is a totally new company. So for those of you wondering how it's affecting your AT&T and Discovery, I don't know if I can find enough information to say exactly what's going to happen, because I need to understand how our if you guys come over here then and you look at our trusty 8-pillar stock data, I'm looking at the cash flow statement here. Look at AT&T's cash flow in the last year, the last few years. I mean, guys, it is
Constantly
ginormous.
growing,
It's got so much free cash flow. How much is that going to be affected? I don't know exactly. The new entity is going to have about $14 billion in EBITDA, which is earnings before interest, taxes, depreciation, amortization. But that's taking away from AT&T and Discovery. As time, this deal was just announced yesterday.
Just yesterday.
As time goes on, we will get more of a consolidated idea of what these statements are going to look like. But from an AT&T standpoint, I do like it from an ATT standpoint in terms of getting rid of debt and saving money on the dividends to hopefully buy back more shares. Now, I've had a lot of people say, should I sell my AT&T? Should I buy more? I don't know yet. But I will know, I do know I'm not touching any AT&T options that I have. If I had a stock, I wouldn't be doing anything with it right now. I would wait until I see the data and figure out what I'm going to do with the new company and the new shares of that. Because that's really the most important part. And by the way, there's a lot of good assets in this new company.
Oh, yes. HBO Max. Then you look at what Discovery has. HGTV, Animal Planet, Food Network, TLC. I mean, they have some
TLC, the band or the channel?
You
band.
love both.
Waterfalls. Don't go chasing waterfalls
Love it.
stuff.
Mo, is anyone trading? What are the people doing with the trading?
Yeah. So when you get big reactions like yesterday,
Look
so
at
this is AT&T. Yesterday, it was up pre-market, and Discovery is even more shocking than this. They were up yesterday, 5% pre-market?
Is that the most obscene red candlestick we've ever seen on the show? That is just crazy. Tell me about it.
So this right here means that it opened up here during the day, and it came all the way down here. If you know, they opened the morning 5% positive, and by the end of the day, they were 3 or 4% in the negative. Discovery on it, let's pull up Discovery's chart. That was even crazier. People, before I did my morning show yesterday, the Discovery opened
Good Lord.
Pre-market, it was up 16% at, call it 7:30 in the morning, Eastern time. By 9 o'clock, it was only up 10%. So I was like, guys, calm down. It's already dropped 6%. By the end of the day yesterday, it was at minus 5% for the day. So this was yesterday. This was where we opened in the morning and where we finished at night. And today you can see it's even further down here. So this thing went from, call it $40 a share to almost $32. And that's a big swing. I mean, this thing is swinging almost over 20%. So when these things happen, just calm down. Don't have an initial reaction and say, oh my God, I missed it. This thing's going up like crazy. 16% to minus 5% in 8 hours.
Sounds like a crypto.
And it does sound like crypto.
And
that's why I say about this. Is that what happened?
That's why I say when you guys get these crazy jumps in the morning, like on AT&T yesterday and Discovery, when we get these big gaps up of a stock, that's why I want you to go and sell and take profits. Take your money off of the table and benefit from this chaos and news that really spikes markets. Everything is going to come back to reality when you get those big jumps.
Final take, Paul, on AT&T Discovery merger. Should I be excited? Should I be weary? What's going on?
I think there will be some cost savings for both companies as well. So if you're an owner of both companies, you should see some overall increase in your cash flow. With the reduction in the dividend, if you bought AT&T purely for the dividend, you're going to be upset. You're going to go from 7.5% down to 5% or so. It's still a healthy dividend, but your biggest goal should be, is my company going to have a better balance sheet going forward? And if they do the things they're supposed to do with this extra cash flow, extra savings, then yes, it'll be fine. They could use this extra cash flow to also reinvest in the future as phones and 5G and all these things become more and more competitive. This is a good thing in the long run for the company. Do not worry. If you're a dividend investor, you're still going to get a healthy dividend, but it's going to be lower. It's not very typical for people liking this, but in terms of the new company and the shares you get, I don't know yet. We will wait. It's going to be about $14 billion EBITDA. I don't know anything about the new shares to be able to make a reasonably good assessment.
And this is not settling down until mid-2022. Either way, it's a long time. Just get your information before you guys start panicking.
That's our take on Discovery AT&T. If this resonates with you, there's a link below for the Patreon. Join our Patreon, Paul. 2,600 of them now, Paul. I'm losing my mind. When we started this, we can't believe it. And sure enough, one of the fastest growing patrons out there and soon to be one of the most successful in the world, Paul. You know this. You're predicting this. It's going to be incredible. So join our community if you want to speak with like-minded people about topics like this. If you like looking at the math and you need Paul to coddle you like a baby with a warm bottle of milk, which I need all the time. You know this. I love you. Tick with a thumbs up on the way out. See you guys. Thanks so much.